1. Welcome to Made for More Living.
One small step for man.
With Johnny Jennings.
Kick the tires and light the fires, Big Daddy.
The fastest and most exciting hour of news, events, and real estate in Northern California.
And this is a fact that was proved.
Powered by EXP Realty. Online at madeformoreliving.com.
Does everybody know what time it is?
Get ready. Here we go.
We are back with another show here on the Made for More Living podcast, and today we have a special guest named JJ Mack with American Pacific Mortgage. Good morning, JJ.
Good morning.
Or hello, whatever time it is. But what we're going to talk about right now is this new product, this new loan product, and been doing some research on it. I'm sure you have a lot to say, and it's quite honestly terrifying to me. Like, I was doing some research, and this is like reminiscent of like 2006, 7, 8, like almost like stated income type loans where people are going to be able to qualify for this product. It sounds great, like a balloon, like a reverse mortgage. It sounds great until it isn't. And we are talking about, it's UWM, right?
Yes.
United Wholesale Mortgage is coming out with a 0% conventional loan.
Correct.
Can you share a little bit about what that is all about?
Yeah, absolutely. Super excited to be here. Thanks for having me, Johnny. Appreciate it. So I'm JJ Mack, work with American Pacific Mortgage, and this product, UWM, have just released. It sounds really good. I was actually really excited for it, and I couldn't wait to sell it. But then I read the fine print and realized that it wasn't as cool as I thought it would be. The reason why, the big reason, is because they will not let you refinance unless you pay off a second mortgage that they're going to slap on there that's for 3% of that mortgage cost.
So basically they're giving you 3%, it's a second, and that's how you're getting away with, like, instead of it being a 3% down conventional, they're giving you that 3%.
Well, it is a loan.
Yeah.
It is a loan. So
it's a loan, yeah.
Yeah.
They're giving you that 3% up front, but in order to refinance, you'd have to pay that 3% back.
Correct.
So let's say your mortgage is and the whole reason why you're getting it in the first place is because you don't have the 3%.
Yeah. So it's a great product for if you were able to refinance, but the problem is that interest rates are high right now.
Yeah.
So if you can qualify for it, great. The problem is that if interest rates go down, you're stuck.
Yeah, because you didn't have the money in the first place. What's going to change between now and next year and the year after?
Right. Exactly. And so it
Interesting.
Put you in a bad situation where now you're going to have to pay it off first. Maybe you're going to have to borrow some money or do something that you don't want to do. And now you're in this position where you can't get out of it.
Crazy that they're even doing this.
Yeah, and so there's a lot of other programs out there that are better, that have that same functionality.
Yeah.
There's one that's called a CalHFA loan that I really like.
Why's that?
Well, because it allows you to refinance it. So
okay.
It gives you that second mortgage.
Without paying it off, though.
Without paying it off.
Okay.
Yes. It's called a resubordination.
Yeah, so if you got a loan for $400,000, or if the purchase price is $400,000, you need 3% down. With the UWM product, that's $12,000. $500,000, it's $15,000. $600,000, it's $18,000. Not a lot of people have that extra cash just sitting around to pay that off in order to do the refinance.
Correct.
And so let's say, compare that to the CalHFA. Now, you don't have to pay that off. It's just sitting there. It's like a silent second.
Yeah, it's a silent second. Just like the UWM product, you don't have to make a payment on it.
Okay.
However, once you do get that interest rate bump lower, now all of a sudden you have the chance to refinance and they will resubordinate. And I can kind of share what resubordinate means.
Please, yeah.
Basically, when you go and want to refinance, that second mortgage is going to take a first lien position. If that the initial first lien, which is the loan, the bigger loan, takes place first. So when you pay that off and you refinance, basically what you're doing is you're paying off that first mortgage.
Okay.
When you pay it off, you put a new mortgage in there with it. So now you've paid off the old one and you bought the new one. But that second lien now jumps to the first lien. And so because it jumps to the first, banks don't want that. They want to be the first lien.
Yep.
Does that make sense?
It does.
Explain that okay?
Yeah. So basically, UWM's 0% down conventional loan sounds maybe better than it is, but the good news is there's a product that does the same exact thing, but better.
Correct.
And how do the interest rates compare between this? Like, why would even UWM come out with this? I don't understand the benefit.
Yeah, because it's something that they have. It's something that they only offer. So they're presenting it as their own thing. And so nobody else can do it. Nobody else has had this product out. However, the way that they're presenting it, it's all marketing. And so the CalHFA loan, however, has been out. It's a good program. It's a California tax-based loan. So we're paying for it being California. Some of our taxes are going to this program.
Okay.
And so that's why it's being looked at, in a different light.
So basically, this is just a shiny object, something that the lenders are able to dangle, the real estate agents are able to dangle, but it's not the best product for clients.
I definitely wouldn't recommend it. I would look to CalHFA loan first.
Okay. Are there different credit score requirements or anything like that? Like, I'm just trying to compare, like, why somebody would even want to do this.
Yeah, I mean, not really. It's all pretty standard. Actually, CalHFA loan opens up a little bit more options than your UWM 0% down product. And the reason why is because there's actually some benefits to the CalHFA loan that this one doesn't have, based off of higher debt to income ratios, some different, and it's basically the same credit score requirements.
Okay.
But the UWM loan is income restricted. And so the CalHFA loan is income restricted as well, but it's a lot higher income. So people are making well over $100,000 can still qualify for the CalHFA loan, where the UWM loan is only the median area, 80% of the median area income limit.
So basically what I'm getting out of this conversation is this is just a bait and switch. UWM is probably going to say, hey, we got the 0% down, come talk to me. And then they're going to pump you into a CalHFA. Yeah,
but if a good thing is if you do get, marketed this product, just be careful with it. I don't want you to get out there and find something and then realize a year from now that you can't refinance and you're stuck. That would be the worst thing ever.
That would be. Totally get it. But then if somebody wants to reach out and learn more about JJ's CalHFA program, just call or text 530-GET-MORE. That's 530-GET-MORE, and we'll get you connected with him right away. In addition to connecting you and learning about that 0% down, if you're a first-time home buyer, 0% down CalHFA program, you also have this great tool, this great calculator. Like, I was just talking with somebody, where were they? West Sacramento. Yesterday in West Sacramento, and they were so frustrated because they've been hopping online. They're trying to figure out, they're going to move to Colorado, and they're trying to figure out what they can qualify for. And they're using these online generic calculators on the big real estate websites. And they're like, this just doesn't make any sense. It seems unrealistic. And the numbers don't add up. So if you're doing the same thing, JJ also has one of those, right? But it's more accurate.
Yeah, absolutely. So we've spent a lot of time and research putting into this program because we've felt the same exact way. A lot of our clients were coming to us and saying, hey, Zillow told me this payment was only going to be $2,000 a month. In reality, it was $3,000 a month. Or, Redfin, or I just went on Google and typed in mortgage calculator and this thing came up.
Yep.
So we spent a lot of time making this so it was perfected. So you knew exactly, well, not exactly, but very close to what your payment was going to be.
Yeah, so if you'd like access to that calculator, just text us or call us at 530-GET-MORE. We'll send it over. There's no cost. There's no charge. We're not a high-pressure company. We just want to get the right information in your hands. But speaking about loans, and, because that's what you do for a living, you're one of the best in the country at it, you have this great program called the Star Loan Program. Can you elaborate a little bit more about what this does? Yeah,
so we really want to take a stance on, serving the people in the communities that are, healthcare providers. So nurses and firefighters and police officers and people that really serve us in our surrounding areas.
Do realtors qualify for the STAR program?
We're working on that.
Okay, thanks. Let me know.
Yeah, and so basically, and we are adding to it. Maybe not realtors, but we are adding to it. And so basically what we try and do is help those out that are helping us. And so we've taken this program and eliminated most of the lender fees and dropping the interest rate for those people.
That's awesome.
It's very cool.
And so what are the qualifications? So firefighter, nurse, lender, firefighter.
I wish.
Are they first responders in there as well, like paramedics and all that, nurses? Okay, cool. And so if you want to learn more about that, again, just call or text 530-GET-MORE, and we'll get you right over to JJ, and he can get you hooked up with that program. So that way, not only are you saving on fees, but you're also getting a lower interest rate.
No doubt.
Awesome. And so speaking about, military and like first responders and all that, there's been a lot of discussion about the VA loan program and how, because let's take us back in history, JJ. Prior to this whole stuff going down with the NAR lawsuit and how commissions can be paid and who can pay what, how has the VA loan program operated for a long, long time?
Yeah, so the VA loan program, what their goal is to help the veteran out. Mm-hmm. That's their main goal, to make sure that they're getting the best possible transaction that's out there. And so they've done that, and they've done a really good job at it. They have less fees, their interest rates are a lot lower, and they make the seller pay for certain items.
Yep.
And so that's really helped the buyer out in the past.
Yeah, the buyer being the VA or the veteran.
Correct.
Yeah.
And so that's really what the VA has tried to do. They've taken these fees, they've taken these costs, and a lot of them they've moved over to the seller side, which in turn, allows the buyer to get a much better transaction, a much better deal.
Yep.
But like you said, this NAR lawsuit has come up, and I mean you can talk a lot more about that than me in terms of what it is and what it's doing.
Sure.
But the VA was the last place to get on board with allowing for the buyer to pay real estate commissions.
So they had lumped in real estate commissions as being part of closing costs and fees that traditionally would not be allowed to be paid for by the buyer.
Correct.
And so now they've reversed that. Is that temporary, or are we taking this like a month at a time, or what's that look like?
So at this point, there's no temporary. They've come out and they've said this is the way it is.
Okay.
So this is, it's not an official ruling yet, but they're saying at this point, this is what they're going to go and do.
Okay.
They can change at any time, but right now they're saying realtors can get paid by the buyers.
So right now, as of this recording, that's allowed, or is this going to go into effect at a later date?
It'll go into effect on July, whenever the
August 17th.
August 17th.
Okay,
correct.
Cool. Good to know. Good to know. All right. And then if you'd like to learn more, if you want to get a hold of JJ and his team, just call or text 530-GET-MORE. That's 530-GET-MORE, and we'll connect you right away. Thanks for being on the show, JJ. When we come back, we're going to talk about cash buys, which is your special loan product that allows people to purchase a home with cash before selling their current home. Back after this.
Mike, it is the biggest transaction of your life, selling your home.
Oh, yeah.
And so people expect more when it comes to that experience. That's why they work with Johnny Jennings and the Tom Daves team with Made for More Realty. For instance, Dave and Melissa, they were retiring, moving out of state, but they needed to sell their home for the most money possible because it was part of their retirement plan. So they worked with Johnny Jennings and the Tom Daves team, able to sell the home for $40,000 over list price in under a week. Can you believe that?
Expect more, get more with Johnny Jennings and the Tom Daves team at Made for More Realty, brokered by eXp Realty. And get more for your home.
This is Made for More Living with Johnny Jennings, powered by eXp Realty. Online at madeformoreliving.com.
So this is interesting. I recently read an article, and it was talking about interest rates, but broken up by generation. So like the greatest generation, boomers, Gen X, millennials, the snowflakes. And then oh
man, I would hate to be
Zers.
called the snowflake generation.
So did I. I was like driving around
Oh
my
my
truck in the oil
gosh.
fields, and they're calling us snowflakes. And I'm
So
like,
you're included in that. You're a snowflake generation?
I am 100% firmly a millennial, yes.
Oh, you're a millennial.
But they were calling us snowflakes because we couldn't take criticism. We just melted.
Wow.
Yeah,
That's
do you
I
interesting.
didn't even know
this?
that was a thing.
It was a thing like maybe 2013, 2015, somewhere in there. Yeah.
So this article is stating which generation has the lowest interest rate.
Correct.
And so what are the categories? Run through it for us.
So they say the silent. I don't like that. I like the greatest generation. I think that's better. Greatest generation, boomers, Gen X, millennials, and then the generation after millennials is Gen Z.
Sure.
So
which one of those generations has had the lowest interest rate when it comes to buying a home? That's the
correct currently, like as a demographic.
Okay, so JJ, what's your guess? Because we haven't seen it yet. So what's your guess?
I'm going to go with baby boomers because I think that they probably have the most equity and the best credit and they probably all were able to refinance.
See, I would think that as well, but I think they had higher rates back in the day when they were purchasing their home. Because we're talking about at what point they were buying homes, right?
No, currently.
Oh, currently. Okay, so what we're doing is we're looking at generations currently and what interest rate are they paying right now on their home. So, yeah, you're right. Maybe the boomer generation refinanced and got lower interest rates. Oh, my gosh. See, you made it tougher. So, boomers. That's a tough one. Yeah. So, wait, what are our choices again?
So we'll narrow it down to the three that are most closely together. Boomers, Gen X, which I don't even know what Gen X.
Gen X is like my age. It's like the 1977 to.
Yeah, it says 65 to 80 on this article.
Oh.
And millennials they move it around. They move it.
Anyways,
it's 81 to 96. Anyway, so between Boomers, Gen X, and millennials, who has the lowest?
I'm gonna go with the Gen Xers.
Your team Gen Xers? You're because you're a Gen Xer. So
because I'm barely a Gen Xer though, barely.
Barely. All right, JJ, what was yours?
I think baby boomers.
Baby boomers? Man, it was millennials.
Okay.
Millennials have the best. Well, I mean, it makes sense, right?
Because they were doing a lot of purchasing. They were doing a lot of purchasing when interest rates were crazy low.
Exactly. Yeah. That would have been my guess, but I didn't know millennials were of age to purchase homes. You know what I'm saying?
Dude, yeah, I'm a millennial. I'm like sitting across from you.
At what age did you purchase your home?
So 1981 to 1996 are millennials. So I was thinking 1996, like they're almost, the youngest millennial is almost
Great
30
point.
years old.
So I'm almost a millennial. I'm 78, so I'm 3 years off.
You can be an honorary millennial.
Oh, no, thank you.
Honorary
I do not
snowflake.
want to be categorized with the millennials. You guys get a lot of flack.
I know we do. I love it because it's not true at all.
Bring it on.
It's a challenge.
Yeah, the millennials. So I was at a conference the other day.
Does it say what their average interest rate is?
Yeah, so the millennials is like 4, Gen X is like 4.1.
Oh,
Boomers is like 4.2.
Oh, so it's pretty close.
It's really close. Those three are really close. Gen Z is 4.9. So those poor young cats are.
But I wonder what the silent generation.
4.3.
Okay, so we're relatively close.
I'm surprised they still have mortgages, honestly. Most of them have probably paid it off.
They might be reverse mortgages, too.
Oh, that's true. That's a good point. But where was I running with all this? Talking about being snowflakes and how I'm going to own it. We were at a Tom Ferry event recently, and he said something that I just totally. So for those of you who don't know, Tom Ferry is the #1 real estate coach in the country. He's been that for like the last 10 plus years. He's a legend in the industry. The dude's
never sold a house in his life.
Never sold a house in his life, but man.
But man, does he know how to coach?
Yeah, but he knows how to sell agents.
If you can't teach.
Exactly. And so what he was saying is your biggest competitor isn't even in the industry yet. So he's speaking to a room full of agents, and he's saying your biggest competitor isn't even in the industry. So I'm looking around.
What does that mean?
So that means so I was thinking about my team, and I have some incredible agents who just got licensed in the last 6 months or so, but they are selling more homes than people who've been in the industry 5, 10, 20 years.
Why is that?
Because they're killers. They're great with people. They're great with their follow-up. They have incredible customer service. They know their market forward and backwards, and they're hungry.
Yeah, and they get to build on what you've already established.
Yeah,
it's just like technology. They're not starting from ground zero. They're building on top of what you've already established. So they don't have to relearn everything that you had to trial and error to figure out.
If I had all that money that I'd spent trial and error,
think about that, right?
I would have a lot more money. But yeah, so essentially, your biggest competitor hasn't even been born yet. And I thought that was very interesting because I'm used to, and you're probably used to this too, JJ, being the younger guy in the room, like the new and up and comer. And then it's like, okay, well, shoot, time marches on, right? We're going to talk about the death clock in a little bit, but that's just interesting. How time marches on. But anyways, back to cash buys. Yeah. We got JJ here, JJ Mack with American Pacific Mortgage, top 40 lender in the country. And if you want to get in touch with them, just call or text us at 530-GET-MORE, M-O-R-E, and we'll get you connected. But he has this incredible product, and it's called Cash Buys. JJ, you mind explaining why this is so great?
Yeah. I mean, Cash Buys is I'm sure you all have heard about something called a bridge loan before, and maybe even a home equity line of credit. And you can use these tools to help you purchase your next home before you've sold your current home. And so cash buys allows you to do that same thing, but only in a different way.
So how is it different?
So cash buys, well, the reason why it's so different is because you can, it's like it sounds. It makes it look like you're buying a house with cash.
Okay.
And how do we do that? Well, we take the equity on your current home and we give it to you. We give it to you, and how we do that is we allow you to purchase this house, and we actually buy the house for you.
Okay.
So it's not. It isn't your. You're on title, but you're on a different type of title. Until you sold your house, are we going to transfer that home over to you? But until then, we're buying the house for you in cash, so you get all the benefits.
So that means you don't have to write a contingent offer. There's you don't have to sell your house and then move into the next house. Like, it really makes it easy. Makes it simple, streamlines the process. And what's the difference between this bridge and HELOC? Just for people, just give us a quick rundown.
Yeah. So let
me phrase it. Sorry to interrupt. Who would want to use cash buy? Who would want to use bridge? Who would want to use HELOC?
Yeah, so huge thing. Listen, this is going to be big. So if you have been in the market and you've been putting offers on homes and you haven't been successful, what do you think would happen if you were to put a cash offer in a home? More than likely, you'd get that offer accepted because you have no contingencies. So now your offer jumps to the front of the pack. If there's 10 offers on the house, they're going to look at cash offers first.
Yep.
This is going to make that happen. And so this is a great program. It really allows you to do that. Where a bridge loan, it is not like that. It can be in some ways, but you're still getting a loan on the property. Mm-hmm. You can do no loan contingencies, but you're still going through the loan process. You're still getting that. Still a great program for a lot of people, but it doesn't allow you to write it as a cash offer.
Okay. And then what's the home equity?
So a home equity line of credit is a little bit different, where if you have a current home, if you can qualify, if you have the income to qualify for your current home and your new home, and you can get a home equity line of credit, meaning you're pulling equity out of your current home, you can use that as the down payment for your next home before you've sold.
Got it. So we just helped somebody do that, didn't we?
Yeah, we have. So we've done all of these programs. One thing that we just did, so we had a client come to us. And he said, you know what? I really want to buy a house. I just don't want to sell first.
Yep.
I said, okay, well, here's your options. So he thought a HELOC would be best for him. So what he was able to do, after getting turned down by about 3 different lenders and going and trying to find a way that would work for him, he was able to find us. We were able to then help him get this home equity line credit.
What do you mean he was able to find you? We gave you this guy. Yeah, we helped you out.
He found me through Johnny Jennings.
Yeah, by calling 530-GET-MORE. 530-GET-MORE. Yeah. So there was the bridge. That was the home equity line of credit, and then quick story. So before the story, is there any income or like minimum loan requirements, or is there any loans too big for the cash buy program?
No, that's the other cool thing about it. The cash buy program does not have a minimum, where the bridge loan will, the home equity line of credit will, cash buys does not.
That's incredible. Yeah, so we're actually in contract with somebody, so we'll see how it plays out, but they are making an offer, cash offer on the cash offer is 2.65 currently, $2.65 million. So this is a huge loan, but they're able to do it because they're doing basically a cash buy program, and our seller is absolutely ecstatic about the offer because it's simple, it's easy, it's fast. And that's the other thing too, you can close these pretty fast, right?
Oh yeah, it's super simple. 10, 12, 14 days, no problem.
Just depends. Once you start getting around the 10, 12 days, it's almost too fast for the seller at that point. They're like, hey, I'm going to need a rent back if you're going to close it that quick. Yep. I need to pack up and move out. Awesome. And so we talked about cash buys. If you want to learn more, reach out to JJ. Just call or text us, and we'll get you connected. 530-GET-MORE. If you want to learn about, or if you're curious about that bridge loan, seeing if that works for you, you can reach out to us as well. And we also talked about the home equity line of credit option. But speaking of home equity line of credits, there's been a boom lately in that. Has there not?
Oh my goodness! Yes, absolutely. It's crazy right now.
So what are you seeing? Like, why are people doing home equity lines of credit?
Well, you guys have probably heard, but we just hit over $1 trillion in credit card debt in America. And so,
is that a good thing?
Well,
If you're a credit card company, I guess it is.
Probably not. And so a lot of people can't afford these payments and they need help.
Okay.
So we're trying to get out there as much as possible and help as many people as they can because they really need it right now. Because credit card payments right now with their interest rates are insane.
That's what I've heard too, is not only is credit card debt at record highs, but the interest that's being paid on these credit cards is also at record highs.
Absolutely.
And so it's just rough. So basically the benefit to somebody if they're struggling with high credit card debt and they have some equity in their home is they can pull out that home equity line of credit, get a lower interest rate, and then pay off their credit cards. Is that correct?
Yep.
And so that saves them on their monthly. Makes buying food, groceries, your mortgage that much easier to pay.
Yeah, I mean, you think about it. You have a credit card with a 20 or 30 or even 40% interest rate on it.
There's 40% out there?
Sometimes.
What?
Yep. It's getting up there.
I'm in the wrong industry. I should be.
I know. Oh my gosh.
So I'll tell you a quick story if you don't mind.
Wait. Before you tell the quick story.
Okay, go ahead.
40%, and people are getting mad at paying an agent 2.5%. But you'll pay your credit card company who wants to cut you off at the knees 40%. Anyways, I digress. What's your story, JJ?
No worries. So basically, we've got a client today who called into our office, and basically, we felt so bad for this lady. She's going through a divorce. And she wasn't able to, she obviously got the bad end of the stick. She wasn't able to make her payments anymore, so she just continued to take more and more and more credit card debt.
Yeah.
And so these credit card companies, as you start building up more credit card debt, the harder it is to apply for new credit cards. And so this lady, unfortunately, had to go out and find these credit card vendors that were offering her even higher interest rates. Her highest interest rate is 37%.
Wow.
And so if you think about that, every single one of these credit vendors has over $5,000, $6,000, $7,000, $8,000, $10,000 on it. So she's paying several thousands of dollars a month for these credit cards, and only way she's able to afford it is to get another credit card to pay it off.
Oh my gosh, it's a death spiral.
The good thing is she has a house, and she had this house for the last 8 years. And so here we come again to save the day, real estate. And real estate has allowed her to take equity from that property and pay off all of that debt because of how she was able to hold that house for so long.
So she was having cards at 20, 30, almost 40% interest rate. That's probably saving her thousands of dollars a month just in interest.
Oh my gosh, she's over the moon right now. She cannot be happier that she'd be saving this thousands of dollars a month.
That's incredible. So not only did she pay off her credit, so she has no credit card debt?
No credit card debt.
Did she do the whole Dave Ramsey thing and cut up her credit cards?
I don't know. Maybe
beans and rice.
Beans and rice, rice and beans. Hey,
it.
I'm all for living lean. Totally get that. However, there is a piece of Dave Ramsey advice that is I really have a hard time with. He says a lot of great things, but I've just seen this particular piece of advice work against so many people. We'll talk about that once we come back from the break.
Well, Mike, the bar has been raised when it comes to selling your home. People want more, they expect more, and that's why folks are working with Johnny Jennings and the Tom Daves team with Made for More Realty. Like Margie and Ben did, they needed to sell their home in Rancho Cordova and wanted to sell it as is and for top dollar. After the first weekend on the market, Johnny Jennings and the Tom Daves team brought them 8 offers, sold the home for almost $20,000 over list price, and they had cash in hand in just 17 days.
17 days. Just Google Made for More Realty today and get more for your home.
This is Made for More Living with Johnny Jennings, powered by eXp Realty. Online at madeformoreliving.com.
We're back with JJ Mack with American Pacific Mortgage, and we are talking about saving up for a down payment. Dave Ramsey says you should save up 20% to avoid mortgage insurance.
That's what I did.
That's what you did?
That's right, because I followed Dave Ramsey because he knows what he's talking about,
He
right?
does.
No? You don't agree? You don't agree with the Dave Ramsey?
Well, here's okay.
Dave Ramsey is like a god when it comes to financial savings and getting out of debt. Don't you agree?
Well, he is.
He's got his own radio show that's,
If that's true.
syndicated. I think it is. I think what it is, you're just jealous of his.
If you
reach
have
of
your own
his
radio show, you should. There's everything you say is truth.
Right.
Everything you say is truth. So, so here's my thing with Dave Ramsey. Here's 2 things actually with Dave Ramsey. One, this is a business. This is, at the end of the day, this is a business, and businesses do not exist if they don't make money. Even nonprofits don't exist if they don't generate revenue.
Sure.
And so when you're listening to somebody, you got to figure out, okay, what's the angle? Why are they saying that? What's the stand? What are they benefiting from? How are they profiting from this message? And when it comes to Dave Ramsey and say real estate agents, like I used to be what did they call them back then? An endorsed local provider. I used to be an ELP. Valerie and I waited years. A spot opened up. We finally got it. And then 3 months after signing up, it was taken away. And you know why it was taken away? Because we were with eXp Realty. And we still are currently as of this recording, because we were with eXp Realty. Even though our ranking was high, even though our customer satisfaction was high, even though we had done nothing wrong, all eXp agents nationally lost their ELP endorsement because Dave Ramsey said, no longer are we going to allow agents to be on here. They even told
Why?
We don't know. They never came out with an answer. But they said, hey, as soon as you leave eXp, reapply, we'll be happy to take you back.
Wow.
So it was not performance-based. It wasn't merit-based. It was because of the company we were with. And so when I hear Dave Ramsey giving financial advice and saying, hey, you should do certain things, I'm wondering, okay, what does he have to stand from it? Because he's clearly not caring about who is the best qualified person in the marketplace. That's not who he cares about. There are certain standards behind the curtain that's not made aware to everybody. And so, again, he says a lot of great things. He helped Valerie and I get debt free. Like, I totally respect what he's trying to accomplish, but you got to look at it through like that filter.
Okay, so let's go back to the 20% down payment.
So
why are you saying
down
that's
payment,
not ideal?
Well, let's say, how long is it going to take for you to say? So let's say the average price somewhere around, let's just say $550,000. 20% of that is, you're the lender. What's the math on that one?
Well, 500,000, 10% is 50,000. So now you're $120,000, $115,000.
How long is it going to take somebody to save up $115,000? Like that's typically like one income. Several years at least, right? And then compare that to what's the normal appreciation rate. Somewhere in our market, it's been as high as, well, it's been really high, but let's just say 3% a year. It's really dialing this number back. We're talking about a lot of numbers, so hang in with me. So how long would it take you to save up 110 versus that same house? Let's say you bought it today for $550. 3% is $15,000. Right. Another 15. So 3 years, that's $45,000. So you, in your financial wisdom, decided to take years and years and years and years to save up. Let's say it took 3 years to save up $110,000, so you can save some money on mortgage insurance. Because that's his whole reason why you want to save the 20%.
Right.
So you don't have to pay the mortgage insurance. JJ, what's the typical mortgage insurance you're seeing? Like, let's say it was a $550,000.
So let's just say you had, 740 credit score and you put 3% down. Mm-hmm. Your mortgage insurance is only going to be roughly around $300 a month. Now, if you put 10% down, it's probably going to be like $100 a month. And it could be a lot less than that if you even have a better credit score. It could be as low as $50 a month. So you're looking anywhere between $40 to $300 a month.
So let's take worst case scenario, $300 bucks. That's $3,600 a year. That's, what is that? 36, 6, 9. So what's that? About 11 grand over the course of those 3 years. That's how much that mortgage insurance is going to cost you. Mm-hmm. Whereas if you had just bought the home, you would have made basically, what is it?
Whatever the appreciation.
$45,000, $60,000. So you lost $50,000 to save $11,000. That's how the math works out in an appreciating market. Are you tracking?
Yeah. But it's not like that money just went away. That went into your home, that down payment.
Yeah, the down payment did go into the home, but you lost that. You missed out if it took you 3 years to save up $110,000, you missed out on 3 years of appreciation if you already had the smaller down payment sitting in the bank.
Right.
So you missed out on all that money just to save $11,000, you lost out on $50,000.
Interesting.
So that's why maybe it's not always the best to save up for that 20%. And let's say that happened, like you say you had the down payment a couple of years ago, and now is year 3. Well, shoot, now you don't have 3 and 4% interest rates. Now you have 6, 7% interest rates, and you missed out on the appreciation. So now you have a higher monthly, even though you don't have your mortgage insurance, you still have the higher monthly. Now, so that's why it's like, you just got to be careful with.
If you have a different perspective, text Johnny 530 get more 530 get more.
Yeah.
So and we're gonna get Dave Ramsey on the show, and you two are gonna go at it.
Oh my gosh! Yeah. My first question.
I mean, you make great points. I mean, I get it. That's a very interesting perspective. But he's been so passionate about this. For years and decades.
So what he does, he looks at it through a worst case scenario.
Sure.
He is very financially conservative.
He just sees so many people getting into debt and it ruining their lives that he's trying to protect them from, those situations. So,
but it's almost like, so 50% of marriages end in divorce, right? If you're down in apparently a Newport, it's upwards of 70% of marriages end in divorce. So
really?
Yeah. So
I was just there.
So should
maybe
don't go there.
We shouldn't visit there anymore.
Oh my gosh, you got to find a different place to go.
70% in Newport, seriously?
Yeah.
Oh my god,
it's a nice place. Why are they leaving? That's a great place.
We enjoyed it.
Well,
there's a lot of temptation down there too.
Yeah, I guess so.
So let's just use the 50% number. 1 and 2 and in divorce. Does that mean your daughter should not get married?
Right.
Right.
Okay. So.
Yeah.
So what are you saying?
So my point is that if you're a divorce attorney, the divorce attorney is probably going to tell you, hey, you shouldn't get married. Make sure you have a prenup. Do all this stuff. You're looking at it through that lens.
Good point. Yeah.
If you're Dave Ramsey and all you hear all day is about financial hardships, you're going to craft a custom message that's very conservative.
That's a good point. Yeah.
So, well, and let's just like a good analogy. Let's just say, there's this microphone here, and I'm going to sell you this microphone for $100 today, but I know in 5 years from now, and in this microphone today, you're going to have to pay a little bit extra every single month to keep it. But 5 years from now, you're going to have to buy this microphone for $150 because it's gone up in value. So would you rather pay a little bit extra today to be able to save some money later on?
And invest
that in something else? It really does make sense when you look at it.
Yeah.
Every single time.
And I think you two are very smart guys. And so that makes sense to you. Right. No, but that makes sense to you. But for the layperson, that's just not. I mean, I think if someone was to take that advice, I think you'd have to walk them through of what, like you've been doing right now, walk them through that of how that makes sense and what you have to do to make it beneficial. Because you guys, obviously you've gone through a lot of education and you do this every day. For the regular mom and dad or person out there, especially Gen Zers, they're not thinking like that. They're not thinking that
They're
straight.
not thinking at all.
Yeah, exactly.
They're still trying to figure that out.
That snowflake generation.
Oh, the millennials. The millennials are getting old. But so what's really cool is that we actually have a tool. So for lack of a better term, we'll call it a simulator, where it's how much money would I potentially make in appreciation if I bought now versus waiting? How much money would I save if I bought now versus waiting? What's the market going to do long term in the next 5, 10, 15 years?
It's true.
And so we have this special tool where we can actually plug in your specific situation and show you on a chart, hey, here's what's going to happen. And so it provides you with the certainty, provides you with clarity. It's not just us throwing numbers at you. It's a written report. And so if you want to get that report, if you want to learn, like plug in your specific situation, it does not cost anything. Just reach out to us, 530-GET-MORE, 530-GET-MORE, and we'll connect you and get that tool over to you. And we'll actually show you how to use it. We'll walk you through it. So that way you can run through scenarios like, hey, if I wait to buy, what is that going to look like? If I want to buy an investment property, what does that scenario look like? There are some other ones too, like your 3-2-1 buy down program, right, JJ?
Yeah, absolutely. And the one that you were just talking about, the wait to buy, what we can do is we can actually put interest rates are a lot lower today, but we can even put an 8% interest rate in there. Let's just say you don't have very good credit. You could say, is this worth it for me to buy today at a higher interest rate or wait? And we will be able to show you exactly what that would look like. So that's really cool. But the 3-2-1 buy down, we do have this program as well. It's really cool, and we have this feature that we can send you, just like Johnny was saying. And in that 3-2-1 buy down will pay. So let's just say you do have a 7% rate that we're going to be offering you today when you buy that house.
Which they are starting to come down a little bit.
Yeah, they are.
Is that going to keep happening, or what do you think is going to happen there?
I think so. I mean, there was some really good news over this past 3 weeks that has happened. We've got some inflation data and unemployment data, all the fun stuff, right? We all want to talk about.
Yeah.
But
riveting.
Yes. But I'll just leave it at this. it's all looking better for interest rates. Now, they're probably only going to cut once this year, and we were hoping for twice over the last couple of weeks, but that's okay. We're still thinking that inflation is coming down.
So the good news is inflation is coming down. So if you buy the loan, and let's say you do this 3-2-1 program, how would that benefit them in the next couple of years?
Yeah, so let's just say you buy this house today and it's a 7% rate, or even now we're actually looking at rates in the 6s again. So let's just say 6.75. So a 3-2-1 buy down, what that does is it allows you to get a 3% less interest rate for your first year. So if you had a 3.75%, would you buy today? I think so. I would.
Absolutely.
Yeah.
We
So-
tell that all the time to our clients. They're like, I'm waiting for interest rates to come down. Well, what are you looking for? Well, I'm looking for a 5. Okay, what if I could get you a rate in the 3s? Would that interest you? Absolutely. So, but that 3 isn't there forever. That right? The 3%.
Right. It's just a rate for that first year to get you in there, and obviously we don't know when rates are going to come down, so we want to make sure the buyer is still okay with the higher interest rate if they do start coming up.
Yep.
Because that rate's only good for the first year, and then the second year goes to 4.75. Third year, 5.75, and then that's 6.75.
So hopefully within that 3-year period, you can refinance to a permanently lower rate.
That's the hope, yes.
Yep.
But we just still want to make sure they're qualified and they're good to go, even if it doesn't. But I would bet, if I was a betting man, I'd probably bet on rates to come down before then.
But even 2 years, what did you say the second year is?
4.75.
So even that,
so you're saving
appealing to a lot of people right now.
Absolutely. So you're saving 3% the first year, 2% the second year, 1% the third.
And you've got 2 years, and the way things are trending, you've
And
got
here-
a lot of options in those 2 years.
There's a lot of life that can happen. Like think
Yeah.
about what you were doing 3 years ago.
Right.
Like it's totally different today, right? There might be some similarities, but what were gas prices, what were food prices, what were interest rates? A lot can change in 3 years. Like we were just coming out of COVID 3 years ago.
Right.
Right. And so as far as what's really great about this program as well is with your company, JJ, not all companies provide this. You're actually you get a free refinance.
Yeah, we do. And we feel really strongly, like I said, about helping our people out and who've worked with us. And so we're not going to charge you again. We want to get you into a home now. We want to help you start building equity. So we're going to pay for those underwriting fees and those costs that we would usually charge when you refinance.
Perfect. So let's use that example again. Let's say you use the CalHalfa program. Or how does that work? What programs can you marry with this 3-2-1?
Yeah, actually you can. So you can do that. So CalHalfa, you can do FHA, you can do the VA, you pretty much do anything.
Okay.
There are some jumbo loans that can't, but most loans you will be able to do a 2-1 or a 3-2-1 buy down with.
So let's say you're a first-time home buyer.
Yep.
You're using the CalHalfa down payment assistance program. So it's 0% down.
Mm-hmm.
Now you're getting a 3% interest rate. That's a lower interest rate than what the market is currently at.
Yep.
So now you're in it for basically no money. And over those next 3 years, let's say use the example that we gave, $500,000 purchase price. Over the next 3 years, you're going to make at least an additional $45,000 in appreciation alone.
Super cool.
Right, and you're getting in with very little money down. So that's why, JJ, you guys work with luxury buyers, but you also do a phenomenal job with first-time home buyers.
Yeah, that's where we started with, back in 2009 when I got into the industry, and it was a great time. And I will say one thing about the 3-2-1 buy down that I love is you get a huge tax benefit from it. I was talking to some of my past clients that we just did loans for a couple of years ago. They're taking these 7 or 7.5% interest rates last year, and they're still being charged the 7 and the 7.5% interest. It's just they've accumulated enough money in this reserve account to pay for that extra interest over the next 3 years when that loan closes.
Yeah.
So what you're able to do at the end of the year, you're still able to take the full advantage of all that interest and save a ton of money at the end of the year.
Oh, wow, that's a bonus.
Huge.
Awesome. Well, hey, if you want to learn more about the 3-2-1 buy down, if you want to get the calculator, if you want to just be better prepared, it's never too early to pre-plan. We've never had somebody come to us and say, "Hey, I wish I would have started this sooner." But we hear almost daily, "Man, I wish I would have started. I waited too long.
Amen.
I wish I would have bought." So just reach out to us. You can call or text 530-GET-MORE, 530-GET-MORE, and we'll get you in contact with JJ and his team. Get you out house hunting. We'll make you a homeowner this year.
Okay, Matt, I don't know how often this happens in your life where you think in your head, don't worry, this isn't that bad. I can handle this. And then you get started and you're like, oh man, I really messed this up. That is something that Matthew was kind of feeling because he needed to sell his house. And so he went and talked to one of his friends who was a realtor and was like, hey, buddy's got this. It's going to be perfect. Until his buddy was like, your house is this situation. Can't do it. Never going to happen. You're stuck with your house. Yes. But Johnny Jennings and the Tom Daves real estate team were able to figure out whatever the complication was and not only sell his house for full price, but to sell it in record time.
Wow, there you go. Hey, here's the bottom line. Johnny Jennings and the Tom Daves team, they sell homes 20% faster than everyone else. And they've got a program where they guarantee to sell your home or they'll buy it themselves. In fact, you can even get an all cash offer. Just Google Made for More Realty today and get more for your home.
This is Made for More Living with Johnny Jennings, powered by eXp Realty. Online at madeformoreliving.com.
Californians are leaving the big cities. They're heading out of San Diego. They're leaving LA, San Francisco.
Are we considered a big city here in Sacramento?
I don't know. It's not listed in the article.
Okay.
We're not, because
we're like what? I think we're like a 27 market, so maybe it's the top 25 markets.
I think we're the top 20. I think
really? Sacramento?
I think Sac Metro is a top 20.
Okay, I'll take your word for it.
Yeah,
That's
it sounds
debatable.
good. Here, let me put it in chat.
You got the
GPT.
answer. Text Johnny 530 get more if you've got the answer to that.
Yep. And so, anyways, they're leaving these big cities, and guess where they're going? Like, we're not talking about like leaving like to Texas, because we know Texas is Texas, but they're actually moving to more rural communities, more rural counties because of the affordability. They still want to be in California, but
rural counties like rural towns like Auburn, Loomis, or are you talking about like suburban like Roseville?
Yeah, so it's broken up by counties. So like the list has Riverside, San Bernardino, Placer County is actually one of the top countries. Yeah, shout out Placer, Yolo. That one was a surprise to me. And then Fresno County.
Wow.
So,
wouldn't have thought that. Okay.
I would. Man, Fresno. I like Fresno. I like Fresno.
Man.
Okay.
Fresno
Johnny
and Kern.
likes the weirdest places.
I do. That's
he
true.
He loves
Well, you grew up in
Bakersfield.
Bakersfield, so.
Yeah.
I grew up in Kalinga.
Sorry.
Valerie grew up in
Sorry.
Bakersfield. Bakersfield's a big city compared to Kalinga. Okay.
You're right.
Kalinga,
Yes, Kalinga.
Fresno, and Bakersfield right there.
Yep. So anyways, California's leaving big cities. And so people are asking me, why? Because people in Placer are wanting to leave the state,
Right.
And I'm like, well, have you checked out home prices or cost of living in San Francisco? It's like moving to Tennessee. It's like moving to Texas.
Well, correct.
Coming to Placer from those Bay areas. Yeah. So anyways, a lot of growth. And actually, Sacramento is one of the few cities, it might be the only major city in the state that's actually growing.
Really?
Mm-hmm.
Wow.
Yeah. That's something else we heard at the Tom Ferry event recently.
Great to know.
Yeah. But you guys mind if I ask you a question?
Do it.
I need some business advice. Should I wrap my car?
So for people that are not familiar with what that is, a wrap is kind of like a paint job. It's like a giant sticker that surrounds your car, and a lot of people do it for marketing purposes. You might see a radio station or a TV station or a real estate
maybe
agent.
a real estate agent.
So you want to get your car, and you're saying it's a Honda Civic?
Yeah, we might get Valor a new car, and maybe might be.
So Honda Civic doesn't have a huge profile driving down the road.
Yeah.
But still, if you wrap it, I think it's a genius idea. I think wraps are smart marketing, especially if you spend a lot of time on the road, right? You're out on the road for how much of the day?
Yeah, I'm out at least a couple hours.
Okay, so there you go. I mean, and if you go to a Costco or wherever you're parked, it's going to be there for people to see. I mean, it just depends on how well it's wrapped.
I mean, the quality of the wrap.
The quality of the wrap, the design, that's
I'm
what's
a horrible.
important.
I'm not the best driver. Like, those stickers that say, "Hey, how's my driving? Call 1-800-whatever."
Exactly. That's exactly what you want. How's my driving? Text me 530 get more.
530 get
I'll help
more.
you buy a home. I'll help you sell your house.
Yeah. No. So you don't think that would be negative?
Nah.
If I accidentally cut somebody off or intentionally cut
No,
somebody
because then
off?
obviously you got their attention.
If people call, then you can just tell them, like, oh my gosh, I'm so sorry. I did not mean to.
Yeah.
But
absolutely.
How can I help you?
Because here at the radio station, we have a station vehicle, and I drive it all the time.
Yeah.
And we get that from time to time. Well, they'll call up the station and say, hey, this guy is driving terribly. He's driving too slow, driving too fast. He cut me off or whatever.
Yeah.
You know, and I feel like, great, you contacted the station. That's positive engagement. Sweet. You know, like that saying, there's no such thing as bad press.
Man, there are some people out there trying their best to prove that maxim incorrect, though. So
Yes.
I hope I won't be one of them. So you guys think I should do the rap then?
I just don't think you should put your face on it, though.
You get a little
I'm like, what do you mean? What do you mean? Like no caricature?
No, I mean, you know what I'm saying.
You saying
So
I got a
so
weird
you're
face?
thinking just the
I have a
logo
face-
and the number?
I have a face for radio. Is what
That's
you're
where
saying.
that's what I'm saying. No, I'm just kidding. I'm just kidding. I just don't know if your face is going to attract more people to call the phone number.
Yeah.
It could. I don't know.
All right.
You know?
So 530 get more. Put a wrap on the car. And
Put your wife's face on it.
I've also heard.
There you go.
I've also
She'd
heard
be the
that
spokesperson and the person that goes out there and puts the name on the car.
we probably need to talk to a tax guy too, because I bet if we got a new car, because the depreciation laws are starting to change, like they're phasing out how much you can write off. I wonder if you can depreciate more or write off more of that purchase price if the car's been wrapped.
Yeah, I don't
You
know.
guys know anything about that?
But you know what else you can do is a lot of big companies have done this in the past. I don't know if they're still doing it, but you can pay other people to wrap their car. Folks that drive around a lot, like let's say an Uber driver, right?
Yeah.
You could pay an Uber driver. It's just like doing billboards on buses. You know,
That'd be
same
cool.
situation. We have a lot of clients on the radio that buy bus billboards.
Really?
And yeah, absolutely. And so there's that option. You could say you find out a really an Uber driver that's busy all the time, that's always out on the road, and you say, hey, dude, I want to wrap your car, and I'll pay you this amount a month, and just as long as you're doing this many miles, and that's an idea too. You know,
That is an idea. Well, hey, if you wanna.
if you're an
chime
Uber
in.
driver and you're listening, and
yeah.
you would be happy for Johnny Jennings to wrap your vehicle for a Chick-fil-A chicken sandwich.
Ooh.
Yeah, we'll do that monthly. Get you bottomless Chick-fil-A. Call 530-GET-MORE. Call or text 530-GET-MORE. Well, JJ, it's been an absolute pleasure having you on the show.
Thank you.
What would you like to? Any last words before we call it quits?
Well, I think we've just been talking a lot about what the benefits are of owning a home now versus later. So I'll just leave you with, if you don't know what you should do, if you're up in the air, I would say there's no bad time to at least try. Get pre-approved, see where you're at, because at the end of the day, it doesn't cost anything. It's not going to affect you negatively. We don't even pull a credit report, soft pull. So I would say go out there, see what you qualify for, and see if it's something that you want to do.
Absolutely. So if you want to start that conversation, again, not a negative pull on your credit. There's no negative ramifications of this whatsoever. There's no cost. Just call or text 530-GET-MORE, 530-GET-MORE, and we'll be able to connect you with a loan professional. Thanks again, JJ.
Thank you.